Inflation accelerated at its fastest pace since 1982. Let's talk about what the experts think about this, changes the rich and the famous are making, and what should we do with our hard-earned money. Hey guys, welcome to Think Finance and happy holidays. Santa Claus rally is a bit bumpy this year, isn't it? With all the buzz around interest rate hikes, the variant and inflation numbers, volatility is back and we are seeing some crazy moves in the stock market. Last I checked, stocks were ripping on Fed Chief's commentary. In this video, I want to talk about inflation, opinions from the experts and the big shots, and what it means for our money. I won't go into details about what inflation is. Take a look at my other video where I discuss it in length. Here's a quick summary. Consumer Price Index measures average change in prices over time that we pay for stuff. Cup of coffee, a burger, groceries, or appliances. Inflation is measured in terms of CPI. If you look at the latest number, CPI is up 6.8% on a year-over-year basis. Basically, on an average, you can expect to pay 6.8% more on everyday items and services. No one reason can contribute to why this number is up at an alarming rate. Fed's printing of money, lower cost to borrow, strong consumer demand for everything, rising income, and supply chain bottlenecks are a few reasons why this number is up. A high inflation number means a hot economy. Too hot or too slow is not good. It needs to be just right. 2% is the Fed's magic number. Obviously, we are way off from the target. When that happens, Fed starts making adjustments. Two things. Number one, tapering. Fun term. All this means is that the Fed is going to scale back all the purchase of treasury bonds and mortgage-backed securities. Why is this important? This spending by the Federal Reserve funds all the stimulus we saw in the last 2 years, which has kept this economy going. Number two, Fed will increase interest rates. How does that work? The idea is to make borrowing expensive. Cost to borrow goes up, businesses and consumers pull back, which limits the money circulation. This typically reduces demand and puts a check on inflation. The question is, what should we do as an investor? To be honest, we all have our own strategies, and making quick changes might sound smart, but it is not always practical. Also, there is no guarantee that moves will work in our favor. Finally, if you sell something, it is a taxable event, which means it could increase your tax bill. For most of us, it just makes sense to stay put and stay the course. With that said, let's talk about some of the strategies to think about. If you already invested in these areas, chances are they might do better relative to other investments. Staying in cash is a bad idea. If you ask me, it is always a bad idea. But it is the worst idea during an inflationary environment. Think about it. As prices go up, the purchasing power of cash goes down. For example, let's say a sandwich used to cost $10 a year back. Today it costs $12. You can no longer buy a full sandwich for $10. Bummer. No cash, instead stay invested. You want to invest for inflation, meaning ensure that your rate of return outpaces inflation rate. Inflation is not a reason to not be in stocks. Yes, there will be some noise as the interest rates go up, but historically stocks have outperformed during high inflationary periods. Indeed, some argue stocks is a hedge against inflation. At least in the short term, there will be some pressure on tech-heavy Nasdaq and hypergrowth stocks. This is because hypergrowth companies rely on future cash flows. As inflation goes up, present value of future cash flows fall. For example, the value of $100 that a company is expected to make 5 years from now may be $80, $75, or less as inflation ticks higher. If you're planning to get into some of these hypergrowth companies, now's the time. They are on sale. With that said, not all tech companies are considered equal. Focus on large tech names with proven track record and strong balance sheet. They'll be fine. I'm talking about select big tech names like Apple, Microsoft, Google, Amazon, Salesforce, and Adobe. On the flip side, value stocks, dividend stocks, consumer staple names, financials, and basically boring names will be fine. At least they will be less volatile relative to the broader stock market. This is because demand for toilet rolls, detergent, or kitchen rolls does not go down, which gives these companies higher pricing power as they are able to increase their prices with inflation. Also, higher interest rate benefit banks. Think Procter & Gamble, Walmart, Costco, Clorox, Bank of America, and JP Morgan. If you did nothing and just parked your money in ETF SPY, you will be able to curb any inflation hit. If you're into bonds, I'm not, but if you are, then TIPS is a way to go. TIPS, or Treasury Inflation Protection Securities, are designed to keep up with inflation over time. To me, bonds is not really a hedge, but more a way to safely stash your cash away. I would rather do something like QILD as opposed to bonds where I can get a decent yield with limited downside. Investing in physical real estate works. Real estate does well during high inflation periods because as inflation rises, so does property values and so does the amount a landlord can charge for rent. I own a few properties and I'm also a landlord. Investing in real estate has been an excellent decision for my family in terms of diversification, appreciation, and a source of passive income. Warren Buffett, in one of his annual shareholder meetings, noted that the best businesses during inflation are the businesses that you buy once and then you don't have to keep making additional capital investments. According to him, real estate is good during inflation, which you buy once and then also get the rise in value over time. By the way, Tiger 21 members also think real estate is the way to roll. More on that later. If you don't have the cash and the ability to buy an investment property, you can invest in smaller amounts via real estate investment trust or REITs. REITs are an easy way for anyone to gain access to real estate without having to buy physical property. And you can also expect to get a decent dividend. ETF VNQ is a decent way to invest in REITs. Fundrise is another option to consider. Then there is gold. GLD is a way to invest in gold. It is an option, but I prefer crypto. It is a matter of time before Bitcoin and Ethereum rule this planet. 4% of my net worth is spread between Bitcoin and Ethereum. I think it is an efficient inflation hedge in this environment. If crypto sounds volatile, maybe you want to do stable coins and make easy 8 to 10% with little to no risk. More on that in this video. But that's just my opinion. The idea is to diversify your money in different asset classes. I have a video discussing this topic as well. Most of my net worth is tied to real estate, stocks, and crypto. Over time, I would like to increase my exposure to stocks. Having said that, real estate has treated me well, especially in the last few years where home prices have gone parabolic. I'll leave you with this video where the Tiger 21 members talk about where they are allocating their money.
Tiger 21 is the largest network global today of high net worth investors. Real estate has remained king for our members. You have today the most extraordinary transformation, in part because of the pandemic. On the one hand, retail is just a disaster. And at the other end, you have the industrial real estate, particularly the last mile facilities that are delivering all the goods and services that people used to buy in person, but are now being delivered. Industrial is up and retail is down. And in the middle is residential. Residential took a real beating in the major cities, particularly New York, but it's on the mend. And the most interesting question mark is office, because we all know that offices will continue to function, but we kind of feel like they're not going to be exactly the same. One of the areas that is just extraordinary is the clean energy transition. A decade ago, 16% of the market cap of public equities was fossil fuel companies, and today it's under 3%. This might well be the largest reduction in value in the history of finance. And what it really tells you is that the markets have understood that fossil fuels have come to an end. So we're going to be driving electric cars. Soon you're going to be flying in electric planes. You're going to see ships increasingly electrified. It's going to happen, and it's going to happen faster and faster. Cryptocurrency has become a really interesting part of our discussion. But when you say crypto, it's really the world of cryptocurrency and blockchain. Blockchain is something that many experts believe will be as big as the internet. Imagine 10 years ago investing in Amazon, Apple, Google, Facebook. But in the private space, there are a lot of new companies that are all about blockchain that will eventually blossom into public companies. You know, the recent volatility is really not that much of a concern at this moment. Most Bitcoin traders understand this is such a completely new phenomenon that it's going to remain volatile, and so they see the current volatility really is quite consistent with their expectation.
Okay, that's all I have, guys. Thanks for watching. Thoughts, comments? Until next time, peace.